guys, welcome to another short accounting video. In this particular video, we will be looking at accounting for revenue under accrual accounting system, under accrual accounting. So this is going to be plainly simple. Of course, there are accounting standards which govern the revenue principle, but we are going to look at in a very simple what revenue is and how do you account for revenue. So there can be three types. There could be cash revenue. Then there's going to be a credit sale, and then there could be deferred revenue. And we are going to look at how to make journal entries in each scenario. First of all, what revenue is? Revenue is basically the cash or the sum of money that you or the business receives from selling a good or service. So let's say this is the company, and you are the buyer. The company will sell you something. It could be either a good or a service, and then in return you pay cash, or it could be credit, or you could have paid in advance for those goods and services, right? So this transaction is called revenue. Under accrual accounting, we have this principle called revenue recognition principle. This principle basically tells us that revenue is recorded by the company when earned. In other words, the company will make, the company will make a journal entry for the revenue when it is earned. So that's a principle called revenue recognition principle. Now let's move on to the entries in those three scenarios. So this is your revenue. You could have cash revenue, that is company received cash after the sale. Then you could have credit sales. This basically means company will receive cash in the future. The payment by the customer will be made at a later date. And then you have something called deferred revenue. You can also call this as accrued revenue. And then there's something called deferred revenue. In other words, deferred revenue is the buyer has paid in advance. Therefore, this is actually a liability. You can also say that customer has paid in advance. The seller or the company will provide service or the goods at a later date, and therefore that's why it is a liability. Therefore it is a liability because the company will provide service at a later date, but the company has received cash in advance. So now let's look at the journal entries. Let's look at uh, the journal entries under each scenario. So if company receives cash, then you simply do debit cash and credit revenue. So let's say the company sold a good for $10. The company will debit cash for $10 and then revenue for $10. This would be the entry if company receives cash. Of course, you should know what debit and credit rules are. If you don't know, I also have a video on that. So please feel free to watch that. Moving on, if company makes a credit sale, if there's a credit sale, what would be the journal entry? In credit sale, this means customer pays later. So you have not received, the company has not received the cash, so therefore you will debit accounts receivable, because you have to receive, the company has to receive this money, or you can also call it as trade receivable, and then you would, as usual, credit revenue. So let's say this was also $10. So this would be, and always remember that debit is always going to be equal to credit. So if you see $10, $10, and $10, $10, right? If the company has deferred revenue, in other words, received cash in advance. Now, how the company will record this? How the company will record this? The company will record this as debit cash received, and then credit deferred revenue liability, or also known as unearned revenue. So again, if this was $10, so $10, right? So you would have this this entry if the company has a deferred revenue, or the company has received cash in advance. Now, all these entries are from company perspective, or the seller perspective. The perspective is very important in financial accounting. So we will move on to one more entry, an extension of deferred revenue, in the next slide. So this is basically extension of deferred revenue entry. Let's say the company performed the service or sold the good or delivered the good. It could be delivered the good because you have to satisfy the obligation. Therefore, the entry there would be debit deferred revenue, or the unearned revenue, because you have to reduce the liability. This is a reduction in liability, because the company has either delivered the service, has delivered the good, or has performed the service, and then credit would be revenue. So this is basically for recognizing the revenue. So if we move back to the previous slide here, so let's say company has a deferred revenue, company received the cash in advance, the company will debit cash for $10 and then credit the revenue or liability. Then in the following months, the company either performed the service or delivered the good. So therefore, the company will debit the deferred revenue, or they will reduce the liability. How do you reduce the liability? You reduce the liability by debiting it. Again, I would like to remind you that you need to know the debit and credit rules. I assume that you know the debit and credit rules. If you don't, I do have a video for that, no worries. So you can always watch that. And then you would credit the revenue for $10, which will recognize the revenue on the income statement for $10 on company's financial statements, right? Thank you very much for watching this video. If this video was helpful to you, please give it a like and subscribe to my channel. Thank you very much for watching.